This video is for educational purposes only and does not constitute financial advice. Please consult a licensed financial advisor before making any investment decisions. If you've ever invested or even just thought about it, you're probably familiar with the golden rule of the stock market. Buy low, sell high. It's the classic path to building wealth. You find a great company, you buy its stock, and you hope that over time, its value will climb, delivering you a tidy profit. And for decades, this has been a fantastic strategy. But what happens when the market doesn't cooperate? What do you do when your favorite stock isn't soaring to new heights, but is instead stuck in a rut, trading sideways for weeks or even months? Or worse, what if the entire market takes a downturn, and all those green arrows on your screen suddenly turn a frightening shade of red? For most investors, these scenarios mean one of two things. Either you wait patiently, hoping for a recovery, or you sell at a loss to prevent further damage. It feels like you're at the mercy of the market's direction. But what if I told you there was another way? A way to potentially profit not just when a stock goes up, but also when it goes sideways, or even when it goes down. This isn't some Wall Street secret or a magic trick. This is the power and flexibility of options trading. Now, I know what you might be thinking. Options? Isn't that incredibly complicated and risky? Isn't that just for professional traders with advanced degrees and a dozen monitors? It's a common perception, and frankly, there's a reason for it. Options can be complex, and if used improperly, they are absolutely risky. The internet is filled with stories of people losing their shirts because they jumped in without understanding the fundamentals. But that's precisely why you're here. The goal of this guide is to strip away that complexity, to demystify the jargon, and to give you a solid, foundational understanding from the ground up. Think of it like this. A stock investor has a hammer, they can use it to build something when conditions are right. An options trader has an entire toolbox. They have hammers, but they also have wrenches, screwdrivers, and saws. They have the right tool for any job, whether the market is building up, tearing down, or just standing still. My job is to hand you that toolbox and teach you, step by step, what each tool is and how to use it safely and effectively. So, what will we cover? We're going to start at the very beginning. We won't assume you know anything. We'll first answer the most fundamental question: what exactly an option? We'll define it as a contract, giving you the right, but not the obligation, to buy or sell a stock at a specific price by a specific date. We'll break down the essential vocabulary you'll need to know, terms like strike price, expiration date, and premium, using simple real-world analogies that will make them stick. From there, we'll introduce the two building blocks of the entire options world: call options and put options. You'll learn that a call option is generally a bet that a stock will go up, while a put option is a bet that it will go down. But we'll go much deeper than that. We'll explore the anatomy of an options chain, that intimidating grid of numbers you see on a trading platform. And I'll show you how to read it with confidence. We'll use examples with well-known companies so you can see exactly how a call on Apple or a put on Tesla would behave in different market scenarios. Once you have a firm grasp on the fundamentals, we'll move into strategy. This is where the theory becomes practical. We won't be discussing wild, speculative gambles. Instead, we'll focus on three foundational, beginner-friendly strategies. We'll start with buying simple calls and puts, understanding the risk and reward of each. Then, we'll introduce a powerful strategy called the covered call, a favorite among long-term investors for generating extra income from stocks they already own. This is how you can get paid while a stock goes sideways. We'll also look at cash-secured puts, a strategy you can use to either acquire stocks at a discount or simply generate income. And perhaps the most important chapter of all will be on risk management. I cannot stress this enough. Trading options without a deep respect for risk is like driving a race car without a seatbelt. It's a recipe for disaster. We will dedicate an entire section to understanding your maximum potential loss on any trade you enter it. I'll teach you about position sizing, setting realistic profit targets, and knowing when to cut your losses. Our philosophy here is defense first. The goal is not to hit home runs on every trade, but to stay in the game, protect your capital, and build your account steadily over time. By the end of this comprehensive guide, the world of options will no longer be an intimidating mystery. You will have the knowledge to understand the basics of calls and puts. You'll be familiar with beginner strategies that you can use to generate income, protect your portfolio, or speculate with defined risk. And most importantly, you'll have the foundational principles of risk management needed to get started safely and responsibly. This is your first step toward adding one of the most versatile financial tools to your arsenal. So, if you're ready to look beyond buy low, sell high, and unlock a new dimension of investing, let's begin. Welcome to the world of options trading, a corner of the financial market that can seem complex, but is built on a surprisingly simple foundation. You might have heard of options being used by professional traders to make speculative bets, or by large funds to protect massive portfolios. And they are used for that. But they are also accessible tools that, when understood properly, can offer everyday investors incredible flexibility and control over their investments. So, what exactly is an option? At its heart, an option is a contract. This contract gives its owner the right, but crucially, not the obligation, to buy or sell an underlying asset at a predetermined price, on or before a specific date. Let's break that definition down because every single word is important. First, it's a contract. This is a formal agreement between two parties, a buyer and a seller. In the world of stock options, one standard contract almost always represents 100 shares of the underlying stock. This is a critical piece of information to remember. When you buy one option contract, you're controlling 100 shares, not just one. Next, and perhaps the most vital concept to grasp, is the right, but not the obligation. When you buy an option, you are purchasing a choice. You have the power to act, but you don't have to. The seller of the option, on the other hand, has the obligation. If you decide to use your right, the seller fulfill their end of the bargain. This one-sided freedom of choice is what you're paying for when you buy an option. The contract is for an underlying asset. While options can exist for things like commodities or currencies, we'll be focusing on stock options. So the asset is a specific company's stock. The predetermined price is known as the strike price. This is the locked-in price at which you have the right to buy or sell the stock, regardless of where it's trading on the open market. Finally, the specific date is the expiration date. Options don't last forever, they have a finite lifespan. Your right only exists until this date, after which the contract becomes void. Now that we have the basic structure, let's look at the two fundamental types of options: call options and put options. A call option gives you the right to the underlying stock at the strike price. You'd buy a call if you are bullish, meaning you believe its price is going to rise. You're essentially saying, I want to lock in the ability to buy this stock at today's price because I think it will be worth more in the future. Let's imagine Innovate Corp stock is trading at $100 per share. You believe good news is coming, so you buy one call option contract with a strike price of $105 expiring in 1 month. The cost, known as the premium, might be $2 per share, so your total cost is $200. A month later, you were right. The stock soars to $120. You can now exercise your option, buying 100 shares at your locked-in price of $105, and could immediately sell them at the market price of $120. Your option contract itself also became much more valuable, and you could have sold the contract directly for a profit without ever owning the shares. On the flip side, a put option gives you the right to the underlying stock at the strike price. You would buy a put if you are bearish. You believe its price is going to fall. This can be a way to profit from a downturn, or a form of insurance to protect stocks you already own. Let's say you're worried about Innovate Corp's earnings, and buy a put option with a $95 strike price for a $200 premium. The stock then plummets to $80. Your put option gives you the right to sell shares at $95, even though they're only worth $80, allowing you to profit from the decline. To really solidify this, let's use our house analogy. Imagine you find a house for sale at $500,000 in a neighborhood you believe is about to boom. You don't have the full down payment, but you want to lock in that price. You approach the seller and pay them a non-refundable fee of $10,000. In exchange, they give you a contract, an option, that grants you the exclusive right to buy that house for $500,000 anytime within the next 6 months. 3 months later, a major tech company announces a new headquarters nearby. The housing market explodes, and the house is now valued at $650,000. Because you hold the option, you can exercise your right and buy the house for the agreed-upon $500,000, instantly gaining $150,000 in equity, minus your initial $10,000 fee. You controlled a $500,000 asset and capitalized on its appreciation for a fraction of the cost. But what if the boom doesn't happen? What if the house value drops to $480,000? You are not obligated to buy it, you can simply let your option expire. What's your total loss? Just the $10,000 fee. You didn't have to get a mortgage or put down a massive down payment. Your risk was strictly defined and limited to the premium you paid. This is the fundamental power and appeal of buying options. So, to recap, options are contracts that give you the right, not the obligation, to buy, a call, or sell, a put, a set number of shares at a set strike price, before a set expiration date. The price you pay for this right is called the premium, and it represents your maximum possible loss when buying an option. Understanding these core components is the first and most crucial step on your journey into options trading. Before you can trade options effectively, you need to speak the language. Options have their own unique vocabulary, and understanding these core terms isn't just helpful, it's absolutely essential. They are the fundamental building blocks upon which every strategy, every trade, and every risk assessment is built. Getting these concepts down cold is your first major step toward navigating the options market with confidence. So let's dive into the 5 key terms that form the bedrock of options trading. First up is the strike price. Think of the strike price as the contract's anchor point. It is the predetermined, locked-in price at which the underlying stock can be bought or sold, regardless of where the stock's actual market price goes. If you own a call option, the strike price is your price to the stock. If you own a put option, it's your price to the stock. This price is fixed for the life of the contract. It's the benchmark against which all profit and loss are measured. When you look at an options chain for any given stock, you won't see just one strike price. You'll see a whole range of them, both above and below the current stock price. Choosing the right strike price is a key part of an options strategy, reflecting your prediction about how much you think the stock will move. Next, we have the expiration date. Every options contract has a limited lifespan. It doesn't last forever. The expiration date is the precise day on which the contract becomes void and ceases to exist. After this date, your right to buy or sell the stock at the strike price is gone. This introduces a critical element to options trading: time. The value of an option is heavily influenced by how much time is left until it expires. This erosion of value as time passes is a concept known as time decay, or theta. Just like a block of ice melting in the sun, an option's time value melts away, and the rate of that melting accelerates dramatically as the expiration date gets closer. Options can have various expiration cycles. Some expire every week, others every month, and some, known as leaps, can last for more than a year. The expiration date you choose depends entirely on your trading strategy and how long you think your prediction about the stock's movement will take to play out. The third key term is the premium. The premium is simply the price of the options contract itself. It's the cost you pay to the seller to acquire the rights that the option provides. Think of it like paying for an insurance policy. You pay the premium to get the coverage. This is the maximum amount of money you can lose when you own an option. The premium isn't just an arbitrary number, it's composed of 2 distinct components: intrinsic value and extrinsic value. Intrinsic value is the real, tangible value of an option if it were exercised immediately. Extrinsic value, often called time value, is the additional amount buyers are willing to pay for the possibility that the option could become more valuable before it expires. This extrinsic value is influenced by factors like the time left until expiration and the stock's expected volatility. More time or higher volatility means a higher extrinsic value, and therefore, a higher premium. This brings us to our fourth concept: in the money, out of the money, and at the money. These terms describe the relationship between the stock's current price and the option's strike price. For A, it is in the money, ITM. If the stock price is the strike price, it has intrinsic value. It's out of the money, OTM, if the stock price is the strike price. For A, this is reversed. It's in the money, ITM, if the stock price is the strike price, and out of the money, OTM, if the stock price is the strike price. An option that is at the money, ATM, has a strike price that is identical or very close to the current stock price. Understanding this is crucial because ITM options are more expensive as they contain that real intrinsic value, while OTM options are cheaper, consisting only of extrinsic value, but require a larger move in the stock price to become profitable. Now let's put it all together with a real-world example. Imagine you're bullish on company XYZ, which is currently trading at $100 per share. You expect good news soon and believe the stock will rise within the next month. Instead of buying 100 shares for $10,000, you decide to use options to leverage your capital and define your risk. You buy one call option contract. You choose A of $110, which is, the is in 30 days. The for this contract is $2 per share. Since one contract represents 100 shares, your total cost is $200. This $200 is the absolute most you can lose on this trade. Let's see what happens. Scenario 1. You were right, the stock soars to $120. Your $110 call option is now deep. Its intrinsic value is $10. $120 stock price minus $110 strike price. You can sell your contract for at least $10 per share, or $1,000 total. After subtracting your initial $200 premium, your net profit is $800. That's a 400% return on your investment. Scenario 2, you were wrong, the news was bad, and the stock falls to $90. Your $110 call option is now FAR. At expiration, it's worthless. You lose the $200 premium you paid. While a loss is never fun, your risk was capped at $200, whereas if you had bought the stock, you'd be down $1,000. This example perfectly illustrates how these key terms interact to create the risk and reward profile of an options trade. Leverage, control 100 shares with less money. Flexibility, make money in up, down, or sideways markets. Income generation, selling covered calls, cash secured puts, but higher risk if not managed carefully. Covered call own 100 shares, sell call for income. Cash secured put set aside cash, sell put to buy stock at a discount. Buying a call option, bullish play, limited risk, lose premium only. Buying a put option, bearish play, protects your portfolio. Options expire, don't hold too long without a plan. Only risk what you can afford to lose. Start small with paper trading. Focus on learning before chasing quick money. If you want more step-by-step guides on strategies like the wheel or iron condors, subscribe for future videos.